All right, so we are still on chapter 11. We're on the next to the last video. We're going to pick up on impairment of value. Sometimes this happens. There could be something going on in the marketplace, and it sort of signals that whatever asset we have has decreased in value some way or another. I mean, it could come from technological advances, things like that. Okay, so um, we could do partial write-downs of property, plant, and equipment and intangibles that remain in use are common. A write-down is appropriate if the company is unable to recover the book value of the asset through future use. New technology, I kind of mentioned that customer demand goes down, and that does happen depending on what our economy is going through at the time. Demand for one product or another could go down or up. Okay. So we have two categories here. We have property, plant, and equipment, and intangibles with a finite useful lives. Okay, that's very important. Finite. And then we have intangibles with an infinite useful life. Okay, so we're going to go through examples of both. Okay, so impairment of value, property, plant, and equipment with finite life intangibles. So GAAP says the assets are grouped at the lowest level for which cash flows can be determined. When are we going to test for impairment? Test for impairment only if any events or changes or circumstances indicate that we might not be able to recover our book value. Okay. So on the next slide, we have a lot of different things that would signal to us. Okay. A significant decrease in market price, adverse change in how the asset is being used. There could be even a law that's passed that makes a certain thing illegal. Long time ago, I had these little mints that I liked. I ate them when I was a kid and then to my early adult years, and then they stopped making them. They stopped selling them. And I was like, where'd they go to? So I started doing some research, and there was an ingredient in them that was banned in the US. So that's why they went away. So maybe that was a good thing because I probably would have never looked at the ingredients, but it was banned here in the US. And so therefore that mint is never being sold here again. So laws can happen and change the course of your business. Okay. So we're going to get into the nitty gritty of how we do an impairment loss. Okay. This is really important because step one and step two are very different. Okay. This can be a little bit confusing. Okay. Step one is we are going to compare the undiscounted cash flows to the asset's book value. Okay. In step one, we are just saying yes, it's impaired or no, it's impaired. We don't actually use the undiscounted cash flows to calculate the impairment, but this just tells us, this just gives us a yes or no. Okay. If it's yes, then we move forward to the next step, and then we compare the fair value to the book value. Okay. Then we will write it down between the difference of those. Okay. Just remember your first step is just answering the question, yes or no. Yes, then move on. No, don't do anything. There's no impairment. Okay. So the amount at which the asset could be bought or sold, that's what fair value is, could be quoted market prices. And if the fair value is undeterminable, it could be estimated. Okay. All right. They give us a problem here where we're going to go through and actually do an impairment. Okay. So this is Dakota Corporation. They operate several factories that manufacture medical equipment. Near the end of the company's 2027 fiscal year, a change in business climate related to a competitor's, this happens, innovative products indicated to management that the $170 million book value, I'm going to come over here in the margins. We have 300 minus 130 to get a book value of 170. Okay. Management is able to identify cash flows from the factory and estimate that future cash flows over the remaining useful life of the factory is 150. Okay. So we're comparing 170 million to 150 million. Yes, it's impaired. Okay, that's the only thing step one answers the question is yes or no. Then they tell us that the fair value of that asset is 135 million. Okay. So, and then step two, there's the book value, and then the 135 is the fair value. We're going to make the impairment adjustment for the 35 million, the difference between the two. Okay. And it could be a little bit confusing. So I kind of like how they actually drew a T count out here for us. It might have been even more helpful if they'd have drew the accumulated depreciation out. Okay. So we see our fair value of 135, book value 170. That gives us an impairment loss of 35 million. They're just taking the zeros off here. Okay. So, I think I am going to do the accumulated depreciation so you'll understand that journal entry a little better. So, accumulated depreciation for the factory asset has 130 million in it. Difference between those is 170, but what we're really saying is the fair value of that asset is 135. Okay. So we've got to take X amount out of fixed assets. Well, we're going to go ahead and depreciate or take that accumulated depreciation out, make that zero. Okay. So then that makes us back into 165. Okay. So come down here. You see the journal entry. We're going to debit the loss on impairment. We are going to debit the accumulated depreciation right there. And we're going to credit the fixed asset for the 165. I like this so you can kind of see the two together. Okay. Remember, step one is just saying yes or no. And that's it. All right. Um, So they talk a little bit about undiscounted estimates of cash flows that are used in step one. The discounted cash flows is what's used in step two, because basically the fair value is saying that it's actually the discounted what it is worth right now at present value. Okay. We do, when we write down and have an impairment loss, we do want to make sure we disclose it. Where did it come from? Why do we think that the fair value went down? What's the effect on the income statement? Okay. So in the next one, we have this little concept check. If you want to pause your video and do that one, you're more than welcome to do that. Then we have a little example of a disclosure. This is Barnes and Noble, and they kind of go in through here and tell us some of their impairment losses that they had. Okay. And tell us what it is. Those are just the notes to the financial statements. Okay. I usually spend just a little bit of time going over the difference between US GAAP and IFRS, but this video is already going to be long, so I'm kind of skip over it. I'm not really testing y'all on that because I do take all of the IFRS questions out of the test bank. Okay, so impairment losses can happen. They have environmental, social, government related issues. Okay, the environment regulations could change. I mean, if you're a car manufacturer and the EPA changes, you're gonna have to redo your whole assembly line and how you make cars. Okay, there is a lot of social issues now. It could be labor disputes with poor working conditions, but everybody seems to hold corporations to this corporate citizenship is what they call that. They want corporations to be good citizens. They want them to give back to the community, blah, blah, blah. When in actuality, the corporation is just there to make the stockholders money. That's really not their job, but it does make us feel good. Like Tom's shoes, it always made us feel good that they were donating a pair of shoes to a kid that didn't have shoes. But the last time I checked, I think they were way behind on donating the shoes that they were required to donate. Okay. And then there could be government sanctions. You could be having operations in another country. Okay. And if something happens in that other country, that's going to affect, you might have an impairment loss due to that. Okay. All right. So the next thing we're going to talk about is the indefinite life intangible assets other than goodwill. Okay. There is no recoverability test, which is great. We don't have that one step no or yes. Okay. We just look at the fair value. If the fair value is less than the book value, we record impairment loss. Okay. That's for everything else. Okay. You cannot recover, and recovery of an impairment loss is prohibited. We don't get to do that. Okay. I'm gonna go on a little bit past some of this US GAAP and IFRS stuff for right now. So let's get into goodwill. Okay, this is a very unique intangible asset. Um, the accounting for it can be very complex. The rules are always changing with goodwill. So before you take the CPA exam, you might want to follow up and make sure you're learning the correct rules because they can change between now and the time you take your CPA exam. Okay. It's really hard to directly associate with any specific identifiable right. Okay. It's not really separable from the company as a whole. Okay. So when you are doing testing, it kind of says this in the next one, you want to look at everything else before you look at goodwill. Okay. When you're looking at goodwill, you're looking at the whole reporting unit. Okay. As an operating segment, um, it's got its own financial information all to itself. Okay. So measuring goodwill impairment, we're going to compare the value of the reporting unit itself with its book value. If the fair value of the reporting unit is less, then we have an impairment loss. Okay. There are some limits. Remember, I just said we're going to do all other assets first. Okay. The impairment loss for goodwill cannot exceed the book value. Okay. So I think in the next problem we have $1 million goodwill. We can't do more than $1 million goodwill impairment. Okay. So there is no subsequent reversal of goodwill. It's already hard enough to measure goodwill. You have the person or the entity that creates the goodwill doesn't necessarily get to record it. It's whatever entity buys that entire company, that's the people who can record goodwill. So it makes a lot of sense that they can't go in and reverse a goodwill impairment because it's really hard to do that. Okay. So here they give us an example. We have 200, I'm sorry, 2026, Upjohn Corporation acquired Pharmacopoeia Corporation, and they recorded $100 million in goodwill related to the acquisition. After the acquisition, Pharmacopoeia continues to operate as a separate company and is considered a reporting unit. Okay, so at this time, 2027, the fair value of Pharmacopoeia was 360 million. Okay. The book value was 440 million. Okay. And the difference between those should be 80 million. I did them a little backwards on that. Sorry about that. But we can see it's an $80 million loss on impairment. So we will debit loss on goodwill impairment and then credit goodwill. And it makes a lot of sense that we don't look at goodwill until it's the very last thing because it's really hard. You can't get goodwill back on as an asset. Okay. So I have a quick little problem. If you want to stop the video and do that one, you're more than welcome to. We're going to move on, and here they give us a couple of examples of goodwill impairment losses that different companies have had. Wow, that's a big impairment loss, 24.8 billion, all the way down to Kraft Heinz, 7.3 billion. Okay. Then they give us another little example. This was Comcast Corporation. They had a goodwill impairment of 8.1 billion. That's a lot of money. That was just their impairment loss. Isn't that crazy? So these are just examples of different impairment losses and the notes that go with them. Okay. I'm kind of jumping over our US GAAP versus IFRS items because this video will get too long. Okay. Assets held for sale. Okay. Sometimes we will hold an asset just to sell it. Okay. We may have been using it in our productions and now we've decided not to. We're just going to hold it. Okay. It's going to be measured at whatever the lower is, book value or fair value. Remember the fair value, they will subtract out cost to sell. I'm just going to put selling cost. Okay. Once they're listed as assets for sale, they are, there's no depreciation or amortization, okay? And they are reported separately on the balance sheet, okay? And here is a nice little summary of all of those things we just went through. And then they have one last slide that we're going to talk about before we end this video. This sort of just kind of makes you kind of think about when you do have an impairment loss, okay? When you have, like some of those companies wrote off $8.1 billion, by writing off those large amounts, it does affect the earnings on that year, okay? It could affect future earnings because you thought you had this asset that you were going to use for years to come, but then you don't because you had to write it down. It's impaired. Okay. So the current year income may be unrealistically low due to that impairment loss. But that's the great thing about our income statement because we have a lot of detail on there. We're going to see that separated out and we're going to be able to differentiate between their earnings that look like they can do again and again and again versus things like selling a building or impairing and having an impairment loss on an asset. Okay. Future income may be unrealistically high because now there's not as much depreciation, depletion, or amortization based on those asset values. Okay. We'll stop there and we'll have one more video to finish up this chapter.